It doesn't start with panic. It starts with confidence. Quiet, steady, almost boring confidence. The kind that makes people feel smart, safe, in control. The kind that makes risk feel distant. And that's exactly where the problem begins. Because the most dangerous financial crises in history didn't begin with reckless chaos. They began with normal behavior. People doing reasonable things. Making logical decisions. Responding to what looked like a stable, predictable world. No villains. No obvious mistakes. Just millions of small, sensible choices? That slowly pushed the system toward the edge. Right now, that idea matters more than it seems. Because when people look for economic danger, they look in the wrong direction. They look for crashes. Volatility. Headlines filled with fear. But by the time fear shows up, the system is already fragile. The damage has already been done. To understand why normal behavior can break the economy, you have to stop thinking of crises as sudden events. And start seeing them as something that builds quietly. Inside everyday decisions. Start with something simple. Every financial system runs on trust. Not blind trust. Expected trust. Banks lend money because they expect to be repaid. Investors buy assets because they expect returns. Businesses expand because they expect demand. Expectation is everything. Now imagine what happens when those expectations keep getting confirmed. Year after year. Growth continues. Defaults stay low. Markets behave. Nothing dramatic. Nothing alarming. Just stability. At first, stability feels like success. It feels like the system is working. Because in the short term, it is. But stability doesn't just reflect the system. It changes it. When things are uncertain, people act carefully. They double-check assumptions. They limit risk. They prepare for downside scenarios. Uncertainty forces discipline. But when things feel stable, that discipline begins to fade. Not all at once. Gradually. Quietly. A bank approves a slightly larger loan. An investor accepts a slightly lower margin of safety. A company takes on a bit more debt. Each decision makes sense. Each one is defensible. Each one feels normal. But here's the catch. The system doesn't experience these decisions one at a time. It experiences them all at once. And collectively, they change everything. This is how risk actually builds. Not through sudden explosions. But through accumulation. Layer by layer. Decision by decision. Year by year. And the more stable things appear, the faster this process accelerates. Because stability doesn't just encourage action. It reshapes perception. When markets are volatile, risk is obvious. Prices move sharply. Losses appear quickly. Mistakes get exposed. The system sends signals. But when markets are calm, those signals disappear. Volatility drops. Defaults become rare. Asset prices move smoothly upward. And the system starts to believe something dangerous. That this calm environment is normal. It's not. It's temporary. But financial models don't know that. They rely on recent data. And recent data looks safe. So risk gets measured using calm conditions. And that leads to a critical mistake. The system underestimates how dangerous it actually is. This is where normal behavior becomes risky behavior, because people aren't ignoring risk. They're misreading it. Now add incentives to the picture. Because incentives quietly push everything further. Banks are rewarded for lending more. Investors are rewarded for taking risk. Companies are rewarded for growing quickly. Governments are rewarded for maintaining expansion. No one gets rewarded for being cautious when everything looks fine. In fact, caution starts to look like failure. If you don't invest while markets are rising, you underperform. If you don't borrow when money is cheap, you fall behind. If you don't expand when competitors are growing, you lose ground. So even if individuals sense risk, they're pulled in the opposite direction. More lending, more borrowing, more exposure. And because the system keeps working, those decisions feel validated. This is where things shift. Risk doesn't feel like risk anymore. It feels like opportunity. And that's when the system becomes fragile. Let's make this concrete. Picture a housing market during a stable period. Interest rates are low. Employment is strong. Prices are rising steadily. At first, people buy homes they can afford. Mortgages are manageable. Debt is reasonable. Then prices keep rising. And something subtle changes. Buyers stretch their budgets. Banks loosen their standards. Lenders compete more aggressively. Not dramatically. Just a little. Because nothing bad has happened. And when nothing bad happens, people start assuming nothing bad will happen, then the behavior evolves. Investors enter the market. Second homes get purchased. Speculation increases. Prices rise faster. Confidence grows stronger. And eventually, the logic flips. People stop buying homes because they need them. They start buying because they expect prices to rise. That expectation becomes the foundation of the system. Now the system depends on rising prices. As long as prices go up, everything works. But if they stop, everything changes. This is the hidden fragility. Not visible on the surface, but embedded in the structure. And it doesn't just happen in housing. It happens everywhere. In stock markets. In corporate debt. In government spending. Stability encourages expansion across the entire system. Companies borrow more because financing is cheap. Investors chase higher returns by taking more risk. Governments run larger deficits because it's easier to do so. Each decision makes sense on its own. But together, they create a system that only works if conditions stay the same. And that's the problem. Because conditions never stay the same. Now here's where it gets uncomfortable. The longer stability lasts, the more extreme this behavior becomes. Because stability creates a feedback loop. Calm leads to confidence. Confidence leads to risk-taking. Risk-taking builds hidden fragility. And that fragility makes the system sensitive. Not to big shocks. To small ones. A slight increase in interest rates. A minor slowdown in growth. A small decline in asset prices. Individually, these don't seem dangerous. But in a highly leveraged system, they don't stay small. They spread. Because everything is connected. If asset prices stop rising, investors lose confidence. If investors pull back, prices fall. If prices fall, borrowers struggle. And when borrowers struggle, the system begins to unwind. What once looked stable, now looks fragile. Confidence disappears. Liquidity tightens. Trust breaks down. And suddenly, the system that felt strong reveals how vulnerable it really was. This is the moment people call a crisis. But the crisis isn't the cause. It's the outcome. The real story happened earlier. During the years when everything looked fine. This is why crises feel like surprises. Not because they're random, but because the risk was hidden inside normal behavior. Now zoom out. Because this isn't a one-time event. It's a cycle. After a crisis, the system resets. People become cautious again. Debt gets reduced. Risk-taking slows. The system becomes safer. For a while. Then stability returns. Confidence rebuilds. And the process starts again. It's almost mechanical. Stability leads to confidence. Confidence leads to risk. Risk leads to fragility. Fragility leads to crisis. And crisis resets the system. Over and over again. Now add one more layer. Human psychology. Because this cycle isn't just financial. It's behavioral. After a crisis, people remember the pain. They become cautious. Skeptical. Risk-averse. But memory fades. Over time, new participants enter the system. People who didn't experience the last collapse. To them, rising markets feel normal. Stability feels permanent. So they behave accordingly. They take more risk. They trust the system more. They assume it's safer than it is. Not because they're irrational, but because they're adapting to what they see. And what they see is stability. This is what makes the cycle so persistent. It doesn't rely on obvious mistakes. It relies on normal behavior. And normal behavior becomes dangerous in a stable environment. There's an irony here. The better things look on the surface, the more risk may be building underneath. Because visible stability often hides invisible instability. Now think about today. In many parts of the world, we've seen long periods of relative calm. Low interest rates. Strong asset markets. Consistent policy support. Volatility has often been muted. Shocks, when they appear, are quickly managed. On the surface, it feels like progress. But beneath that surface? The same dynamics are at work. Debt levels have increased. Valuations have expanded. Markets have become more interconnected. None of this guarantees a crisis. But it changes the system. It reduces its margin for error. It makes it more sensitive. It makes small problems more dangerous. And that leads to an uncomfortable conclusion. Risk doesn't build when things are falling apart. It builds when things are working. Because that's when people stop questioning assumptions. That's when leverage quietly accumulates. That's when the system becomes most exposed. So now we're left with a difficult question. If normal behavior creates systemic risk, what are you supposed to do about it? Because acting too early has consequences. Tightening conditions during stable periods can slow growth. It can look unnecessary, even harmful. But acting too late means the system has already become fragile. This is the dilemma at the heart of modern economies. There's no clear signal. No obvious turning point. Each step looks reasonable. Each decision feels justified. Until suddenly, they don't. And by then, the system has already shifted. This is why the idea is so unsettling. It challenges something fundamental. The belief that stability means safety. Because in reality, stability can be the very thing that creates danger. Not immediately. Not visibly. But gradually. Quietly. Inevitably. So the next time everything feels calm? When markets are steady? When growth looks reliable? When risk seems under control? It might be worth asking a different question. Not whether things are stable, but what that stability is allowing to build beneath the surface. Because the most dangerous moment in any financial system isn't when people are afraid. It's when they stop being afraid. And that leaves one final question. If normal behavior is what quietly pushes the system toward crisis, how do you ever recognize the danger? While everything still feels completely fine?